The Asian financial crisis of 1997. There was an overheating of the economy, and the rapidly growing Southeastern Asian countries formed a bubble. The bubble burst on July 1997. It was known as the Asian financial crisis of 1997. This crisis began in Thailand after the Thai baht, which is Thailand's currency, collapsed. Thailand had a huge foreign debt and was bankrupt. There were fears of the financial contagion spreading worldwide. It did. The crisis spread through the rest of the region, and other countries of Southeast Asia saw their stock markets fall. Indonesia, South Korea, and Thailand were the most affected. The rest of the countries were less affected, but they all experienced a fall in demand and confidence. The Association of Southeast Asian Nations, or what is known as the ASEAN, had a debt of 180% in the worst part of the crisis. But what went wrong? Were they victims of their own success? The most affected countries by the Asian financial crisis were Thailand, South Korea, and Indonesia. In Thailand, from 1895 to 1996, its economy was growing very fast, on an average of 9% per year, while the inflation kept somewhat stable. However, on May 14th, the Thai baht was greatly hit by speculative attacks. What started the crisis was the government's failure to react and defend the baht. Thailand's economic prosperity ended, and the baht lost more than half of its value, as the Thai stock market dropped 75% and the devaluation of the baht dropped by 20%.
The market forces were simply too powerful for the IMF or any government to contain. In late 1997, contagion reached Korea, one of the most successful economies in the world.
Further on, in South Korea, the banking sector was doing poorly as there was excess debt due to non-performing loans and negatively expanding South Korean corporations, which further on increased the economic problems. For example, in July 1996, Kia Motors felt forced to ask for emergency loans.
It's unbelievable that the crisis has spread as quickly as to Indonesia and Korea within a matter of 6 months or 7 months. But the world was much more globalized than we thought it was at that time.
Lastly, by June 1997, Indonesia seemed to not be affected by the crisis. A low inflation, a great trade surplus, and a good banking sector placed Indonesia far from crisis. Many corporations had been borrowing US dollars, which was a good idea since the Rupiah, Indonesia's currency, had strengthened. However, when the baht was attacked, the Rupiah dropped. The IMF also had to intervene with a bailout package of $23 billion, but the baht kept on falling. In November 1997, it reached its record low and eventually the president Suharto resigned. Before the crisis, the exchange rate was about 2,600 rupiah to $1. After the crisis on January, it stood at 11,000 to $1. The crisis caused a loss of 13.5% of the country's GDP.
Prices collapse, companies collapse, and in the case of Indonesia, the social fabric collapsed. Churches have been burned, mosques have been attacked. They have killed each other. And it's all the fallout of an economic collapse.
The crisis in Asia had many macroeconomic-based effects. The crisis had a great impact on the countries and left many of them in great damage. There was a reduction in the values of currencies and in the stock markets. Many businesses failed and collapsed. As a result, many people fell below the poverty line in 1997-1998. The crisis also led to a political upheaval. The economy started overheating, which increased demand, and as a result, investors didn't see the underlying weaknesses of the economies. After the crisis, GDP values decreased greatly. The nominal US dollar GDP of ASEAN fell by 9.2 billion in 1997 and by 218 billion in 1998. There was a 31.7% change in only 1 year. The nominal US dollar GDP per capita fell 42.3% in Indonesia in 1997, 21.2% in Thailand, 19% in Malaysia, 18.5% in South Korea, and 12.5% in the Philippines. Economists have been analyzing this crisis. The strategies used to restore confidence after the crisis were as follows. First of all, the monetary policy was established so that interest rates were manipulated. The fiscal policy took account of the costs of restructuring the banking system. Financial institutions that are insolvent were declared to be closed or bought by stronger ones. Lastly, political leaders should show transparency and strong accountability.